Thank you, Donna. Well, good afternoon for those of us that are on the East Coast, and good morning for our audience on the West Coast. We thank you for taking time with us today to discuss Year 15 dispositions. We've been hosting this WebEx session for a number of years now, and this presentation has evolved with the market over time. So we look forward to sharing with you today some insight as it pertains to the enterprise portfolio with respect to expiring LIHTC properties, but that also in the context of nationally the industry, the LIHTC industry. So with that said, I'll start out by taking a look here at what does the landscape look like right now with the national LIHTC stock. There's nearly 3 million units out there in the LIHTC program. They're in a number, pretty much covering all the different markets, urban, suburban, and rural markets across the country. This program has been up running for over 30 years now, providing housing for families and seniors and people with special needs. There are different levels of affordability throughout the LIHTC portfolio. There can be, it seems that there's a majority with deep affordability. 64% of the residents are at or below 40% of area median income, and that's according to the HUD database. It's also interesting to note that with the LIHTC portfolio, there is a rising wave in coming years of LIHTC communities where the extended use horizon restrictions horizon is approaching. That will certainly have an impact on disposition strategies out there in the marketplace. Before I get into our experience specifically there, just a little bit more on the national landscape. It's a very favorable market for sellers out there with LIHTC communities on the market. There's a growing pool of institutional buyers of affordable housing communities that are seeking cash flow yields. National average cap rates continue to be fairly low at around 7%. So there's a lot of activity out there and a lot of new buyers that are coming into the arena. At Enterprise, within the context of our portfolio and our experience, we were in the LIHTC program from its inception in '86, '87. And to date, we've completed over 800 dispositions that consist of over 40,000 units. In addition to our property dispositions, we've also, these dispositions has led to the dissolution of 27 funds. We completed 90 dispositions in 2016 and continue to have a robust Year 15 pipeline of about approximately 100 partnerships per year. Our typical exit structure, and Sean is going to go into this in much more detail later, and we'll also be providing some good case study examples. But the typical structure that we've seen within our portfolio is that these transactions are being effectuated as an assignment of limited partner interest. And that's primarily because our general partners are long-term preservation owners. They're not seeking or motivated to do third-party sales. They are committed long-term to the affordability program and to serving the residents in their communities. The assignment of limited partner interest has some advantages to it. There's no change in title, which can provide for some reduced transaction costs, i.e. transfer taxes in some states, and recordation fees if there's no change in deed. And the legal agreements are a little simpler. Our transactions with the assignment basically consist of two documents. It's the assignment agreement, which is effectuating the assignment of the existing limited partner to the new substitute limited partner. And then there's also usually an amendment that reflects that change. That would be those documents with the assignment of a limited partner interest. That would be opposed to like a real estate purchase contract under a fee simple sale. We certainly do have those on occasion, but that would be when there is a third-party sale. But out in the industry as a whole, there certainly are, as I was indicating earlier, large volumes of transactions that are third-party sales where there's, you know, general partners who are highly motivated to sell these properties at the expiration of the compliance period. I would also add that we don't just see dispositions upon the expiration of the compliance period. We often can have a disposition that will occur during the compliance period. We refer to those as early exits here at Enterprise. Again, that's a disposition within the compliance period. The makeup of that type of transaction and what is a project that would be a good candidate for that look like. The partnership would need to be beyond the credit period and delivered all of the credits. The investor would have received all of its benefits. There would be a recapture indemnification provided by the general partner slash seller that would provide a full indemnification to the investor against any recapture. We also build into our documents the right for some continued asset management and reporting if we elect to exercise those rights. We're not looking to continue to asset manage deals that our funds are no longer invested in, but we certainly want to retain some rights in case a problem would arise to go back and check files. But we're certainly going to require the annual certificate of compliance that the general partner normally files with the state to continue to be sent to us, so we can see that that's being done and that the property remains in compliance. Additionally, the property certainly would need to be in compliance and expected to remain in compliance. I think that these requirements are fairly typical for what I'm seeing out there when I speak with other syndicators and see what else is going on. Additionally, in today's market, particularly with an early exit, the investor consent quite often would be required beyond the syndicator, meaning I'll talk about this in a little bit more in a few minutes, but the fund level, the fund limited partnership agreements would have specific requirements for the syndicator to go out to the investors in the fund to get their consent for an early exit. And I can tell you our experience has been even more so here in the last couple of years, and it seems to be the trend that the investors are expecting material economic upside when being asked to approve a early exit. In essence, they're looking to the limited partnership agreement provisions for the purchase option provisions in the limited partnership agreement to drive that transaction, and Sean's going to go through that in a little more detail later. Of course, there can be some exceptions if an early exit is a strategy for the workout of a troubled asset. Just kind of high level, the objectives of this training. We will provide you with an understanding of the background on year 15. We will go into and discuss key exit options and option provisions in the partnership agreement, specifically the right of first refusal provisions that are common for nonprofits through Section 42, as well as buyout options for limited partner interest. As we go through this, we'll be giving you some different perspectives from the different stakeholders that are involved in the transaction, and emphasizing the importance of understanding who those stakeholders are. It's a brief discussion on Reese Indication. Candy Felix, who is with us today from our TRA department here in Enterprise, is going to discuss with you capital accounts and exit taxes. And we'll walk through a timeline for an action plan from a developer perspective and a syndicator, and then we'll go through some case studies that will be taking a look at 3 different transactions, nonprofit and for-profit. Now this slide, you know, as fundamental as this is, it's key. When looking at developing a disposition plan, it's very important to go into the file cabinet and get the limited partnership agreements and all the loan documents and everything out of the cobwebs and dust them off and start, you know, preparing an abstract of what are the rights and the roles and the obligations of the different stakeholders and the different provisions of the partnership agreement, making sure that you understand those in detail in terms of purchase option provisions, and formula prices, to do an analysis of those, to understand what they are, what they may offer, and it, you know, can help you very much with understanding what different options are, and that will assist you with developing your plan. It's very important to know the property as the property stands today, and then what are the needs of the property going forward. You know, I would encourage you to obtain a capital needs assessment as part of your year 15 planning process. Some of the key stakeholders, just to highlight, really nothing new here, but, you know, first and foremost, the residents, which is what this is ultimately about. You know, with the assignment of limited partner interests as the majority of the structure of our deals, we don't see a large type of impact on the residents, but a lot of times a disposition plan shortly thereafter or in some time in the near future may involve some form of recapitalization where residents may be impacted, and you have to plan accordingly for that. Of course, you know, the general partners and the investors make up the partners in this partnership agreement. You know, you have the investor limited partner. That could be a direct investor or a multi-investment fund. Syndicators, which are the intermediaries often for the investor and with the general partner. Private lenders, public lenders, very big player in this program, and often with a lot of provisions in their regulatory agreements that you otherwise might not have with private lenders that are very key when working through a disposition plan. For example, you know, the loan documents regulatory agreement may provide for affordability restrictions that are more stringent than the extended use restrictions, or maybe even go out further, you know, depending on the maturity date of the loan. You know, state allocating agencies, what role do they play? Do they need to approve the transaction? And of course, there's the Internal Revenue Service that has been monitoring compliance. So this slide and the next slide will discuss a little bit about the structure of LIHTC investments. I think this is very important. This and the type of investor that you have is critical to developing a disposition plan, because this will lay out the framework of what has been agreed to by the parties, and depending on whether it's a single investor fund or a multi-investor fund, you know, how many investors are you actually dealing with on a particular transaction. So this illustration right here, the 3 boxes, you know, I'll start at the top. The way, you know, these investments are typically structured is the investor will provide capital into an equity fund by being a partner in that fund. And that equity fund will comprise of a general partner, typically with a 0.01% interest, and that very well would be, like in the case of Enterprise, we're the general partner as the syndicator of that equity fund. Then you would have a limited partner that's comprising of the 99.99%. Now that could be one investor, and so that would be a proprietary or a single investor fund, or it could be a number of different investors that make up that 99.99% interest of that equity fund. And then the equity fund is invested in the project partnerships, and the project partnerships are the partnerships that own the real estate that is financed through the LIHTC program. The equity fund would typically hold a 99.99% limited partner interest in that project partnership, and then the local developer / sponsor holds the 0.01% interest. It's the project operating partnership that the development partner would be entering into with the equity fund, and that's the fund agreement that the developers have and live by. So to elaborate a little bit more on this, the partnership agreements, both the equity fund partnership agreement that was in the middle box on the prior slide, as well as the operating partnership, they control the disposition process by providing different provisions. They'll provide for transfer restrictions. They may have formula prices. Some of you out there may have deals that have puts in them, which obligate the general partner to purchase the property or the limited partner's interest at a formula price at the end of the compliance period. Or again, there could be a right of first refusal for debt plus exit taxes for a nonprofit. The equity fund agreement and the operating partnership, limited partnership agreement are going to provide the consent requirements. Typically, a limited partner's consent is required at an operating partnership level for any disposition. The operating partnership agreement will provide a waterfall, as we refer to it, that spells out how any residual proceeds would be distributed to the partners. And within the context of that is the liquidation and dissolution provisions. And I know that Sean will go into this a little bit more now, but I would say that, being engaged in Enterprise's Year 15 disposition program since its inception, I've seen this, a trend move over the years, particularly post-2008 and even more so in the last couple of years, where there's a trend in the industry where investors are more focused on residual proceeds from these operating partnership agreements, and they're very focused on the liquidation provisions of the partnership agreement. And what's key there to the liquidation provision is that in the waterfall, unlike a liquidation waterfall, which comes into play when you execute a right of first refusal, or typically even on a buyout option of an LP interest, when you look at how it's written in the agreement, the liquidation waterfall is what is triggered. And that waterfall contemplates a rebalancing of capital counts of the partners, and that comes in a higher position of the waterfall than a residual split per se. So that can really have a material impact on how proceeds, the amount of proceeds, how proceeds are allocated among partners. So it's very important for the limited partner and the general partner to understand what those liquidation provisions look like. What type of investor is in the transaction is important to know. There's a couple different types of investments. There's direct investors, where a syndicator is not a part of the transaction. And then there are syndicated transactions where the equity fund limited partnership is a multiple investor fund or a single corporate investor fund. Early on, not with Enterprise, but with some other syndicators, there were multiple individual investors in funds. But here at Enterprise, we don't have experience with that, but if you do have that, you'd have to work through those types of consent issues. I think it's important to note here that the type of investor, single investor fund or multi-investor fund, definitely impacts the communication flow and the development of a strategy on a disposition plan. When you have a single investor fund and we get a proposal from a general partner to do a disposition, it's a lot easier when you can pick up a phone and contact an investor directly to discuss the plan. If, for example, it's something, what's being proposed is outside of what the provisions of the partnership agreement. However, I would also add that a trend has been in single investor fund agreements. Investors are writing in provisions that give them more control over the disposition. For example, control over selection of appraisers, whether a bona fide offer may or may not be required for a right of first refusal, stronger consent requirements, things of that nature. Multi-investor funds, we have funds that have 2-3 investors in them. We have funds that have 20 investors in them. And, that will, what's important there is that one needs to understand that the syndicator has to present the proposal and work through a consent process with multiple investors. And wherever you have, multiple investors, you have multiple motivations of doing things. And different investors may have different tax implications. So it can, add a layer of complexity to the transaction. And I would say that it could certainly increase the timeline for doing the transaction. It could take more time. So those are some thoughts on some of the nature of globally with the LIHTC program and some of our experience. Before I hand it over to Sean, I would highlight that at Enterprise, we're a double bottom line syndicator with a strong mission component to long-term affordability, working with long-term preservation owners, and having a long-term relationship with core investors that know our business and know our customer base. Our goals upon disposition, as a good fiduciary to our funds is to deliver the expected benefits to the investor. We believe overall that our investors are motivated to exit these transactions in year 16, which would then position the fund to be dissolved in year 16 or year 17 upon the disposition of the last operating partnership. We had, by design, envisioned these investments staying with our long-term preservation sponsors, and that's what we're seeing happening. That's also in line with what the HUD study produced in its report in 2012 on the year 15 horizon. That a majority of our, certainly our earlier deals, the majority of our sponsors are nonprofits, and those communities, even as reported as HUD, continue to remain affordable. Ownership is retained by the nonprofit, and they're continuing to serve the communities, preserving the affordability through the extended use period and beyond. We work closely with our sponsors in developing disposition plans, again, with an emphasis on preserving affordability, and, additionally, enterprise, where we can, we'll provide equity to Reese Indicate deals with new tax credits, and additionally, we can provide debt to help recapitalize projects on the back end. So with that said, I will turn it over to Sean Barnes.
Well, thank you, Greg. Now, since we're spending an hour and a half this afternoon or this morning if you're on the West Coast talking about year 15, we'll take this time to address the significance of year 15. This year 15 marks the end of the compliance period, and therefore investors can get out of these partnerships without the risk of recapture. These transactions have been considered or envisioned as 15-year investments, and as Greg mentioned, most of our investors are ready to dispose of their interest in year 16. So therefore, this whole process is going to start with determining when year 15 is. You can either use your fingers and toes, or you can go through an analysis that Candy's going to address.
Thanks, Sean. So I'll talk about determining year 15. As Sean mentioned, the investors are trying to come out in year 15, so how do we know when year 15 is? This is not a date that is found in your partnership agreement, operating or limited partnership agreement. This is a calculated date. So it becomes important to understand how to determine that. And it's usually the last day of the 15th year when credits were first taken. And it could be different for different buildings. If you've got usually in scattered sites or projects with multiple buildings and you're having different place and service dates. So we'll do a little bit of an example to sort of bring that out in my next slide. But what you want to do is to plan your disposition in year 16, and that's the year in which the last building began taking its credits. So here's the example that I mentioned. So in this example, the project was allocated credits in 1999. The building started its construction and was placed in service, which was completed in 2000. They elected to defer credits to 2001. The credit period would end in 2015, because what we were doing here was we were saying that we took credits for the first time, and this is just assuming that this is a single building, or if it's a multiple building, the credits on all buildings are commencing in 2001. So what we do is we say 2001 is the first year of credits. We know that the compliance period is a 15-year compliance period, so we would add 14 years to that. Or you can use your fingers, but I just use 2001 and I add 14 years to that, and that's how I get to my 2015 deadline for my year 15. So year 16 is 2006, and that's when you you want to get out by year 16, January 1 of year 16 in most cases on Enterprise's end. So I'll pass it back to Sean, and I'll come back later with a couple of examples.
Thank you, Candy. So at year 15, we have several options available to us as a strategy to exit the partnership. For the general partner has these options available. I'm going to go through these in more detail later on, in particular in my case studies, but just right now, just to give you a brief overview of some of the strategies that are available for the year 15 exit of the limited partner. One is a right of first refusal to purchase the real estate. And I emphasize real estate. This is an option or a sweetheart price that's available in the code for the named party, the named nonprofit, to acquire the real estate from the partnership for a formula price, which again I'll go into later. But again, this is only for the real estate. Most partnership agreements also typically will have a buyout option, which allows a named party to buy the partnership interest, a limited partner interest in the partnership. Qualified contracts do exist for a formula price. We don't see too many of them these days. mainly because of QAP qualifying scenarios, as well as somewhat pushback from certain states. They don't like to see these properties go to market, so they might make some states will make the process slower. Some states, it's an attractive option as far as the state's concerned. Those are places where market rents and restricted rents are kind of close. Bargain and sale, we'll touch upon this briefly, but we don't see these anymore in today's market. As Greg mentioned, in 2008 there was a big economic shift, whereas the investors are now not interested in write-offs. They're more, if there's going to be a residual value, they're interested in capturing some of that residual value. We also have an early exit as an option to exit the limited partnership. Now, this would occur before year 15. And again, we'll go through some of those requirements that enterprise has and what we're seeing in the market. Now, some of these partnership agreements will contain a put, which will be an option to purchase either the real estate or the limited partner interest. We at Enterprise don't see too many of these, so our deals are either the general partners follow the partnership agreement, and if we can't come to an agreement via the LPA, the limited partnership agreement, then it becomes a negotiation. And of course, we also have a sale of the real estate to a third party as an option for an exit. Now, the right of first refusal is a formula price, and I'm going to emphasize it as a price. It's not value per se. It may equal value, but it may not. It's a price that's set forth in the partnership agreement, which is outlined basically by the code, Section 42, which allows the holder of the right of first refusal to buy the real estate for debt plus taxes, and there may be an adjuster for unpaid benefits. This is available to tenants, management corporations, qualified nonprofits, and government agencies. And I do have a couple examples that I'm going to go through. We'll give you specifics. Some of the issues with the right of first refusal is a third-party offer required. At Enterprise, we do not require the third-party offer. If the general partner is related to the entity that holds the right of first refusal and they bring that offer to us, we will entertain it. Again, I mentioned that the right of first refusal is for the real estate only. It does not include reserves, and that's a serious consideration that general partners need to think about as they approach year 15. Those reserves may be distributable, and if you have to keep the property in good working order for the next 15 years throughout your compliance period, you want to make sure those reserves are rolled into the property, if you will. Repairs are addressed as they're needed, and the property is well maintained throughout the entire compliance period, and not just, you don't want to save the money for a rainy day. If the property needs the reserves to be spent on it to maintain the NOI, then you want to go ahead and spend those funds. The right of first refusal does come with transaction costs. Depending on the state, it may be a transfer tax for the real estate, but also setting that aside, there may be wind-up costs, accounting fees, and legal fees to wind down the partnership after the real estate is sold. The right of first refusal is a transfer of the real estate, and that would typically trigger the dissolution of a partnership. And as I mentioned, the formula price may not equal value if your debt plus taxes exceed the value of the property, which you might obtain from an appraisal or some type of third-party resource, that it may not be an attractive option. The buyout option is for the purchase of a limited partner interest. And usually it's a defined term in your partnership agreement, and it'll spell out exactly what it entails and if there's a waterfall involved. It will include the fair market value of the LP interest, and it equates to a liquidation value, if you will. If it's a defined term, it'll state something to the effect of what the partners would receive if the property was sold at fair market and a waterfall, the liquidation waterfall, was followed. The other half of the equation to compare it to would be any unpaid benefits plus exit taxes when determining the LP, or the limited partner interest purchase price. Qualified contract is also a formula price. We don't see a whole lot of these. Some states, it's an attractive option for the developer because property values might be sky high, and there's some motivation to roll these to market. That's not the intent of the program. Like I mentioned earlier, several states are pushing back against this, and it may make it hard, or maybe next to impossible to get the qualified contract to go through. And the price that's calculated for the acquisition or to make a property available to roll into market usually is pretty high. When you do the math, the calculation comes out pretty high, and so it's hard to sell the property at that price, and therefore the general partner could take it to the state and the application to the state and theoretically remove the use restrictions. Again, we don't see that a whole lot, but it does happen out in the market. We do have a bargain and sale, which we don't see these anymore, really since 2008. And as I mentioned earlier, investors are looking for a residual return versus a write-off at the end of the year 15. No problems advancing my slides here. Mm-hmm. An early exit, as Greg mentioned, is an option. We do have some requirements that we ask the general partners to follow. Primarily that we want a strong assurance that the property will remain compliant throughout the compliance period. We no longer require a bond at Enterprise, but we do have an indemnity agreement which needs to be executed by the general partner or the indemnitor. And as part of that process, we do determine internally the risk of recapture and then the indemnitor's ability to cover that risk financially going forward. Now for Reese Indication, I just want to touch upon some high-level points. We do have a syndication team here that if you have any specific questions after this presentation, you can just shoot us an email and we'll put you in touch with the right people. But recapitalization of the project in year 15 is often a concern from our general partners. Again, they have to maintain this property through at least through the end of the extended use period, so they may look towards a refinance or a resyndication. And some of the items that you want to be aware of when if you are considering resyndication is, number one, start the process early. But look at your project and determine if there's any significant capital needs. As Greg mentioned, and we're going to mention a few times in this presentation, a capital needs assessment is really a key tool that will help you with your year 15 planning, and we recommend getting one of those sooner rather than later, and we also recommend considering a green CNA, considering where the market is going today. But there are minimum rehab requirements that will make a resyndication attractive or feasible. There's some minimum requirements of 20% of the acquisition basis, or $6,000 per unit, but what we're seeing in the market today is the total needs exceeds $30,000 per unit to really make a deal look attractive to investors. You want to determine if there's any, if you can pass the 50% rule, and in particular the 10-year look-back period to see if you have 50% or more of related parties going into the next transaction. You want to look at your extended use restrictions to see if they can be carried over. Consider the vacant unit rule to make sure your compliance period, you remain compliant throughout the period. If there's any units that are offline, how long are they offline? Are they going to trigger recapture? And if you need to find out who your original LIHTC deal investors are, that's going to vary per syndicator. And Enterprise, for confidentiality reasons, we don't typically give the whole list of investors, but we can give a letter stating whether or not there's a mixture of investors or if there's a carryover of investors. And when that time comes, you can simply request that typically a general partner will come to us and say, hey, these are the new investors that are coming into this deal. Are they related? Is there a crossover of relationships? You want to look at your loan documents, as Greg mentioned, dust those off to see if there's any, if you can forgive any of the loans, if they can be rolled over, if there's prepayment penalties. The 50% rule is on a building-by-building basis. And as I mentioned earlier, the rehab requirements for these deals needs to be extensive. Typically in the market, we're seeing that an annual allocation of $500,000 is pretty much the minimum to make a deal attractive. Now, these deals can be combined. We'll have an economy of scale and maybe combine several smaller projects, but that doesn't necessarily make it a a simple deal. That might just make it more attractive to the investors. Again, as I mentioned, these portfolio deals may not be simpler, but these can be more attractive. Consider whether there are any tax-exempt bonds that need to be restructured, and you want to look at the debt analysis and maintain your capital accounts throughout your changeover into a Reese Indication. Now I'm going to turn it over to Candy. He's going to talk about capital accounts, and capital accounts are going to become very important at year 15, as we'll discuss later.
Thanks, Sean. And usually this is the part of our presentation when our CPAs on the line get excited and our general partners get excited as we talk about exit taxes and capital accounts. But before I go into the exit tax part of the presentation, I just want to talk about what are the components of the limited partners capital account. And first we have to start with the capital contribution, the investment that the limited partner makes. So that's a positive that goes into the account. Any distributions that are paid out to the limited partner would reduce your capital account. If you're getting taxable losses, which is something the investors pay for, that reduces our capital account. In some instances, we do see partnerships that are pushing off income, and that would increase the partnership accounts. Not a lot of our deals are cash cows, but from time to time we do see some of those. If your partnership is getting historic tax credit, that's a write-off that you get right away. So if your partnership gets the 20% historic tax credits, that reduces our limited partner capital account. If we're paying syndication costs to syndicate the limited partners interest, that reduces your capital account too. By definition, the limited partners capital account cannot go negative. So they're limited to their investment unless there's this thing that the IRS tells us we can go negative if there's minimum gain. And minimum gain, it's just a big topic. You could probably have a week session on that. So I'm just going to give you a little bit of definition. And what it is, it's really just your non-recourse debt. So that's debt that is secured by the partnership. It's not necessarily related party debt, unless there's some things we can do to have related party debt show up as non-recourse debt. But the debt has got to be attached to the building, and the owner's got to bear the economic risk of it. So it secures the building. And then we take the net book value of the asset. This is a taxable book value. And for the accountants on the line, you know that if there's a GAAP calculation of depreciation, that might be different from the book the tax calculation. So we're taking the tax net book value against the non-recourse debt. And if it's positive, then you do have some minimum gain. We track the tax basis. We track our capital accounts on the tax basis. Not all deals have that. If you're invested in an enterprise partnership, we do have a tax basis capital account that we track, so you can get that from us. If you're not an enterprise partnership and you're not sure if your account is on the tax basis, you can definitely go back and grab all your tax returns and just go through them individually in Section 3 of your Schedule K-1s, and you can calculate your tax basis capital. All right, the capital accounts on transfer must be negative. We've got to get the limited partner back down to 0 in order to transfer. If the ending balance is positive, it means that we have recorded less losses. We've written off less losses than we had originally projected, and that would mean that the partnership has to recognize income. If the ending balance is negative, then a gain is recognized, and it means that the benefits have exceeded the investment, and that triggers the exit taxes, which means that the limited partner has gotten more benefits than he has invested. And we also look at the time value of money, and more investors are understanding this theory and are okay with it, because $1 today is worth more than $1 later. So they're willing to take more losses today and pay the exit taxes a little later on. So I just want to go through a couple of examples with you. Hopefully these examples will bring out what we are talking about when we talk about managing our capital accounts. In this example, the investor has invested about $1.4 million of equity, and I know this graph is a little busy, but I just want you to focus on where the arrow is positioned, and that's year 15. For the most part, enterprises deals are, we like to underwrite our deal with this assumption, because what it's saying is that your capital account remains positive throughout the compliance period, which is year 15. So we're getting our benefits and we have enough capital to take it. There's no need to have minimum gain in this example. So this is where we'd like to be, ideally. As you can imagine, this is not always the case. Things change, and we can have a different scenario, and that's represented here in the example 2, where we do have the capital account going negative in year 12. In this example, it's not too bad, because we're outside the credit period, which means that the investor's gotten his credits that he paid for, so that's good, and he's got losses. And at this point in year 12, we can start talking about reallocating losses to the general partner, because the limited partner may not have the ability to take it absent minimum gain. So we do have some deals that are underwritten this way, and it's okay to have the account trending to go negative as long as it's after the credit period. The position we don't necessarily like to be in is in this third example, where the limited partner's account has been exhausted in year 8. And as we talked about, the compliance period is year 15, but what's more important for the limited partner in maintaining a positive capital account is that it's positive throughout the credit period, and that's the years in which they're actively taking credits. And most of you know that the credit period is usually a 10-year period. The IRS allows us to take 15-year credits over 10 years. So we try to make sure that the account is preserved at least over those 10 credit years so we can take the credits, because depreciation on the building will determine, if you can't take the depreciation on the building, which generates the credits, you can't take the credits. And in those cases, we have to adjust the equity because the limited partner is not getting all that they're paying for. In cases like these, we could look to see if there's equity that is coming in a little later, beyond year 10, and our investors might be willing to do a deficit restoration obligation. And those are date certain, and they expire after the date that's included in the agreement. So we have ways to sort of mitigate some of the risks that will show up here. Enterprise do not underwrite deals that are projected to go, where the LP account is projected to go negative during the compliance period. So that's one good thing. But you could imagine if losses are trending higher, and we have a capital account that is really, really close, already projected at year 10 or the end of the credit period, and anything changes in the partnership structure in terms of the revenues and income, it could create an issue. So we at Enterprise Monitor in our department, we monitor that very closely, and we started to talk about ways to do that, which I'll talk about a little later. I just wanted to talk a little bit about an exit tax example. In this case, we had the exit tax is really equal to the sale price plus is equal to the debt plus exit taxes. In this example, the limited partner had a negative capital account of $500,000, which means he went over his investment, and this is possible because he probably had minimum gain. So assuming that he's got an exit tax liability, he's got a capital account that is negative $500,000, the exit tax liability is usually calculated at the federal rate, which let's assume is 35% for this particular partnership. That would mean that he has to pay $175K of exit taxes. In our partnership agreements, it's stated that the exit taxes are responsibility of the general partner to pay this exit taxes. So the general partner might have to write a check for $175,000. Now, when the general partner writes that check for $175,000, that represents income for the limited partner. So we all know if the limited partner is getting income, they'd have to recognize that, and on the income they have to pay another tax on receiving income. So every time they receive the income for the exit taxes, it generates a taxable event. So you could imagine this can go on and on indefinitely. So what we do is we just do a one-time gross subtractor. So we'll collect that $175,000, which is 35% of $500,000, and then we'll collect another $61,000, which is a one-time gross up on that, and then we just stop there. We don't continue to take taxes every time we get income for the same exit taxes. So some ways to manage our exit taxes, and this is what we Enterprise do a lot when we're seeing that an account is going to go, it has a potential to go negative. We sort of suggest that we look at ways with the general partners to forgive debt. If we forgive related party debt, it generates income as opposed to losses, which increases the limited partner account, which is good. Now, we want to make sure that we're forgiving related party debt or debt that is not part of a minimum gain calculation, because if we move debt out of a minimum gain calculation, it makes the issue worse. So we just want to forgive debt that is not related party. We could reduce the limited partner interest by 1/3, which doesn't create a technical termination, but we just reduce the amount of ownership that the partnership has. We can relate qualified non-recourse debt or add security to debt if it's possible. There's some legal ramifications with that, but that's an option that we can look at. And what this does, it changes the minimum gain calculation because it adds more debt to the qualifying debt. So it increases the ability to take more losses and reduces the negative balance that's in the capital account. We can look at capitalizing expenses rather than expensing them, capitalizing repairs rather than expensing them, because what that does is adds to the net asset, and you will pick up expenses in a longer period. So if you've got an asset that is 27 years and you're enhancing the asset, now it's got to fall within the capitalization policy that you have. So if you're changing carpets or doing any major improvement and extending the life of your asset, you can choose to capitalize that, which sort of slows down the expenses that run through the income statement and reduces the losses that actually goes to the limited partner. This one is sort of what I think people do the first time. They try to improve the operations, but the reason why we're usually in this situation is because improving operation is probably not your option. In year 16, you can look at doing a bargain sale. As Sean mentioned, this is not a very popular way to get rid of the partnership, but what that means is that we just add the exit taxes to the bargain sale price, so you don't have to cover that on your own. There's some options to paying the exit taxes. If there's exit taxes existing, you can get a new loan that is sufficient to pay off the existing debt that includes the exit taxes. Reese Indicate the deal at a purchase price that includes the exit taxes, and see if you can apply any cash reserves to the payment of the exit taxes. I know there's some sort of restrictions in certain states that you can't use existing reserves for this purpose. Try to apply a back-end adjuster to pay for your exit taxes, or most of our groups like this one. See if the investor can absorb the exit taxes. And now I'll just pass it back to Sean, who will pick up from here.
Thanks, Candy. And as Candy mentioned, monitoring the capital accounts is extremely important throughout your initial compliance period, but it's also very important at year 15, as I'll highlight in a couple of my case studies. But as with anything else, proper planning is key for success. So we recommend an action plan that starts early, and I'm going to go through a basic action plan that our partners can start in year 10 to get ready for year 15, and then I'm going to go through 3 case studies that outline the benefits of not only doing that, but also what can happen at year 15, which may take time. So years 10 through 13 is a good time to start your plan. You want a plan that's going to last not only through year 15 and exit the limited partner, but also a plan that's going to take you through the remainder of the compliance period. These projects do have capital needs typically at year 15. You want to make sure you have ways to meet those needs. We begin our analysis, if you will, by determining when the compliance period ends, and Candy went through that calculation. The general partner will need to examine their perspective. Do they have the desire or the capacity to purchase the project? Do they want to stay in affordable housing? Some of these groups got in 15 years ago, and it might not be such an attractive option to stay in now, or they may not have the capacity, staffing-wise, et cetera, to maintain the project. And also want to get a feel for where the investor sits. Talking to this indicator, determine whether the investor is flexible with a sale or a transfer of interest, and also, very importantly, whether or not their benefits have been realized, what they were promised at the beginning of the compliance period. If they have been delivered, then that makes the disposition a little easier. Years 10 through 13 is a good time to go through your economic projections. Do you have the cash flow that will sustain the project going forward? There's going to be any changes in the budget, such as lost tax abatements or rental subsidies, or any kind of balloon payments that may become due. And you want to look at your project and to see how marketable it is, and not only for the perspective of selling the market, but are your units rentable? Can you keep your occupancy at the level it is needed to be viable going forward? Again, you want to review your capital needs, and if you can get a capital needs assessment early, that's great. And in particular, Green CNA. A Green CNA will address energy efficiency items as well as health issues that will help make your project more sustainable and marketable in the future. And as Candy just spent a few slides talking about the capital count and the ramifications on exit taxes, you want to determine that early as possible. Because both of those, the exit taxes may come into play when it comes in determining your purchase price for the limited partner interest and or the exercise of the right of first refusal, because the exit taxes are considered in both of those formula prices. Years 13 and 14, it's a good time to dust off your partnership debt documents and see if there is any balloon payments that are due. Compare your property value with the amount of debt you have on the project. You may have to get a broker opinion of value or an appraisal of the real estate and determine if the real estate value exceeds the overall debt on the property. Your loan documents and or a phone call to your bank can determine whether the loans can be assumed, forgiven, or restructured. And several lenders will have not only affordability restrictions, but they'll also have approval rights. The approval process for the lenders may take some time. So again, it's good to reach out and touch base with your lenders as soon as possible to make for a timely year 15 exit. And in year 13 and 14, hopefully no later, maybe the early year 15, determine what your buyout price is going to be. You'll review your partnership documents for a buyout option and or a right of first refusal, if you have that. If they make economic sense and the general partner wants to pursue those options, you present the offer to your syndicator or your direct investor, however you're structured. Typically, we reach out to our general partners at least 2 years in advance with some questions to prep them for this whole process and point them to the partnership documents so that they become familiar with what their options are to purchase either the limited partner interest or the property, and also what type of funding might be available to maintain the project going forward. To meet these purchase prices, you can look at a resyndication or a refinance. If the partnership does have substantial reserves or cash, those can be used to purchase a limited partner interest. That could be a combination of all the above, and there may be grants available to partners to maintain the project as an affordable project going forward. Excuse me. And year 15 is a great time to meet with your syndicators, what we're doing here today, or consult with your accountant and your attorney. Work through the negotiated purchase price, and at Enterprise we like to send out a letter of intent outlining both sides' responsibilities and proceed with the transaction. We ask the general partner to touch base with their lenders and get any type of approvals that are needed, and then we'll go ahead and draft legal documents to effectuate the transfer. So in year 6, our goal is to close in early as possible in year 16 at Enterprise, first quarter if possible. If required, we'll ask the general partner to file a certificate of limited partnership. We file the final tax returns, the final K-1, and we execute the amendment to the partnership agreement, which would show that the current limited partner is leaving and the new limited partner is coming in. And these will be signed by all parties. Now, this whole analysis that we're talking about today may sound familiar because these are the items you probably discussed in year 1. Is the financing going to take you through the extended use period? How long will the rent subsidies last? Is there any ballooning debt? Are the improvements in good shape? Can they be maintained? Do you have the funds to maintain the improvements going forward throughout the extended use period? And if a resyndication is considered, what are the scoring agency's requirements? And of course, you want to perhaps restructure your projections going forward to address any changes in NOI or ballooning debt, and if need be, alter your depreciation schedules or any other items you can to slow depreciation to mitigate any kind of exit tax. Now, these 3 partnership case studies that I'm going to go through right now were approached in the same way we just discussed, and all 3 deals really had a different strategy and outcome, which is typical, especially if the deal has value in excess of debt. The process and the outcome can vary, and it often goes to a negotiation. When we have our first conversations with our partners, again, we point to the limited partnership agreement, which does drive, obviously, operations throughout the initial 15-year holding period, but also it gives you the options as our starting point for the year 15 exit. And again, that's typically either a buyout option for the LP interest or a right of first refusal if there's a nonprofit for the purchase of the real estate. This first project is a deal that does not have value in excess of debt. It's a great project located down in Baltimore, serving seniors 62 and over. Has a wide range of rent restrictions from 30 to 60%. Placed in service in 2002. Using our fingers and toes, we realized we can exit in year 2016, and this deal did have an extended use period that takes it through 2041, which is important considering what type of capital needs might be needed between now and then. Stakeholders in the deal: we have an established nonprofit, very active in the community and in the industry. We have singular investor fund as the limited partner, and Enterprise is obviously the syndicator. It's a deal that we just worked through. And we have several lenders, and as and state allocating agencies as stakeholders. And of course, most importantly, we have the residents. In this deal, we do have a nonprofit that holds a right of first refusal. If that right of first refusal was exercised, as I'll go through a little bit later here, the limited partner would receive $111,000. The general partner cited strong capital needs. They have a large cash flow loan. The project really cannot be recapitalized due to the age and the availability of credits. Cannot be refinanced because of a prepayment penalty, which makes it cost prohibitive. And they do, again, have significant, or did have significant capital needs. In this scenario, they identified $700,000 in capital needs, $200,000 of which is short-term capital needs, usually needs that are immediate needs within the first 5 years of the exit, and or life safety issues. And this is just a snapshot of the partnership value. That we run this type of analysis early on in the process, and in particular in year 15 when we have current financials to figure out where the property stands economically. And essentially it's just a comparison of all the assets with all the liabilities of the partnership. The real estate is valued internally via an income approach to value or a capitalization approach to value, where we take a market-derived cap rate, cap the current NOI, the stabilized NOI, to come up with the value of the real estate. In this scenario, it's $2.1 million. We add to that all other cash assets, reserves, escrows, and cash in the bank, and we subtract short-term liabilities, fees payable, and long-term debt. And we come up with a partnership value. And in this scenario, as you can see, the liabilities exceeded the assets, and so there's a negative partnership value. Now, we see this a lot. A lot of our projects are heavily rent-skewed, mission-minded developers trying to serve the community, so they're not necessarily going to look real positive at the end of year 15 from an economic standpoint. So a lot of our exits do look this way at year 15. Now, if the general partner were to exercise the right of first refusal, this is just a breakdown of what that would look like. The formula price is the same. It's just debt plus taxes. We mentioned there's no exit taxes in this deal, so it's just going to be debt. There would be closing costs with that the partnership would have to incur with an exercise of the right of first refusal, outside of the transfer tax, where the transfer tax would typically be rolled into the purchase price for the real estate. But the closing costs would consist of accounting fees, legal fees, those fees necessary to wind down the partnership and close the books on the partnership. So if we do the calculations here, we take our purchase price less the closing costs. We have a negative sale proceeds of $25,000. We add cash and reserves, and we subtract any kind of accruals or fees, and we come up with total possible proceeds of $223,000. I put an asterisk here. Per the liquidation provision, and you'll see this a few times in these case studies, the proceeds shall be distributed in accordance with capital counts. And this is very common across partnership agreements across the country, across the industry. So you might be looking at your partnership agreement and see a certain waterfall, but if the liquidation is triggered by an event, and the sale of the real estate is typically an event that will trigger that liquidation, then the liquidation waterfall comes into play, and that can be substantially different than what you as the general partner thought was going to happen at year 15. Now in this scenario, we had capital counts that were equal. This is very rare, but essentially the total capital count was 334. The GP's portion was 50% of that. The LP's portion of that was 50%. So if we followed the liquidation provision in this partnership agreement, proceeds would be distributed per the capital count balances, again, 50-50. And that's where we arrived at that number that I mentioned earlier, the $111,857 for the purchase price. That's what the limited partner would receive if the right of first refusal was exercised. Now keep in mind, we compared that to what we determined was really a negative partnership value. So this slide, and I'm going to have one of these for each of our case studies, summarizes not only the financials of the project, but also the typical valuation scenarios that we can look at and surround the value, if you will. I'll point your attention to the bottom of the page where we have the valuation summary. You'll notice that the sale of the property or dissolution and or the buyout option equate to the same thing. Essentially, because the buyout option would be a hypothetical sale of the property at an assumed value, and here we have this 2.1 value for the real estate. If we add assets and liabilities, we have a negative partnership value in both of those scenarios. If we follow the right of first refusal and subsequent dissolution of the partnership, we do have a dollar amount of $111,000 that would go to the limited partner. So you would ask, why would a general partner want to exercise the right of first refusal? It didn't make economic sense in this deal. They are a nonprofit, they're well established in the community, and they want to maintain the project going forward, so they want to give up needed resources just for the acquisition of the LP interest. Well, in this scenario, the right of first refusal. But from the fund's perspective, we negotiated this deal, which really amounted to that we transferred the limited partner interest just for debt. From the fund's perspective, this makes sense. The reason the fund was set up was to preserve a long-term affordability. Their benefit, the investors' funds have been delivered. Their IRR exceeded target. And the partnership, the nonprofit does have a right of first refusal where they could acquire the real estate for that price. But again, does not make economic sense. So the general partner is going to assume all liabilities and assets in this deal, and we exit for no monetary consideration. Now, number two here is a for-profit deal that does have value in excess of debt. Now, you notice that the rent is pretty heavily skewed here, but the deal does have value and significant value in excess of debt. This is a deal that we looked at the partnership documents. The general partner made an offer after consideration of the partnership documents, and it turned out to be a negotiation versus following the letter of the law in the partnership documents. Here, the general partner did have a buyout option to buy the LP interest. An important note here is this general partner stepped into this deal in 2012 when the project was troubled, and this became a part of the story, if you will, a part of the negotiations. And we had the investors involved in this early on in the process, in the conversations. Back when they stepped into the deal, they changed the economics of the deal from a 10-90 split in the capital proceeds waterfall to a 90-10 in favor of the general partner. Now, this was important if there was a capital event, but we're talking about a liquidation event if they were to exercise the buyout option or to buy the real estate. Either way, it would be a liquidation event. So that waterfall would not be triggered. However, it does show the intent that occurred back in 2012 that they're trying to make the deal more economically feasible towards the partner for their role in stepping into the deal. Ultimately, the general partner made an offer to buy the LP interest for $300,000, and after several conversations, we negotiated a price of $500,000 for the limited partner interest. And this is how we did it. This, again, is a snapshot of what the partnership looked like in year 15, again, comparing assets and liabilities. We did have a valuation or a third-party valuation of this real estate, and you'll notice the cap rate's a little lower here. It's a 6% cap rate. But same analysis of income approach to value. We value the real estate, add other assets, subtract all liabilities, and we come up with a net partnership value of $2.6 million. Now, if they were to exercise the buyout price to buy the limited partner interest, this is how the math would flow. We've had closing costs that are basically the cost of the hypothetical sale of the real estate, which is outlined in the partnership agreement. The waterfall is outlined in the partnership agreement. If we add net assets and liabilities, come up with total proceeds of $2.4 million. And again, I put an asterisk here. This is going to be a liquidation, so it's going to trigger that part of your partnership agreement, the waterfall in that part of your partnership agreement that allows for a liquidation and how proceeds are distributed. And again, this may look different than what the partners thought was going to happen when they came into the deal. So the capital counts here were heavily skewed towards the limited partner, which is often the case. They're the ones that put in most of the capital, and typically at year 15, their capital counts are going to be a lot larger than the general partner's capital count. So in this scenario, if they were to exercise the buyout option, that would trigger the liquidation, and therefore the general partner would get 0.0004% or $1, and the limited partner would get 2.4. So that obviously wouldn't look very attractive to the general partner. Why would you give everything away to exit the limited partner? Now this is a breakdown of how a third party would step in and value this. And often we'll go to this, if we can't come to an agreement in the partnership agreement, we may bring in a third party valuation of not only the real estate but also the limited partner interest. And this type of valuation addresses the value as a going concern. It's not, liquidation is not contemplating, it's just what's the value, they're determining what the value is of the limited partner interest out there in the open market. And in this scenario, the residual, we'll see my little asterisk on the bottom there, the residual splits in your capital proceeds waterfall or section of your partnership agreement will outline how an appraisal would determine residual value. So in this scenario, like I mentioned before, in 2012, they renegotiated the capital splits in our documents. It's Article 8, but here the general partner is going to get 90% and the limited partner will get 10%. So that 10% is essentially the limited partner's economic interest in the partnership. But an appraiser wouldn't stop there. That's, basically the limited partner has 10% of the net assets of the partnership. But if a third party is coming in to buy the LP interest, there would be a discount applied for lack of control and marketability. This is not a full 100% equity stake. There's appropriate discounts based on, the new limited partner, by definition, does not have control of the partnership. So they want to discount the purchase price for that reason. Typically, we're seeing about 25% in the market when we have a third-party appraisals come in. They identify a discount of about 25% for lack of control. And we also have identified a marketability discount of roughly 25% for a total of almost 50% discount. So the fair market value of the interest would be, in this scenario, $150,000. And again, this is if somebody were coming off the street to buy the limited partner interest, what they would be motivated to pay for the limited partner interest. And again, this is a summary that outlines the different approaches to value that we had in our conversations with all parties involved. And again, the sale of the property, this is an appraised value, and the buyout option was an appraised value. And you can see that the proceeds would get distributed heavily to the limited partner. There's not a lot of economic motivation for the general partner to follow that route. This partnership did not have a right of first refusal, so we don't have any numbers in there. And then the fair market valuation showed the value of the LP interest of $150,000. Ultimately, in heavy consideration of what the general partner did to step into this deal and turn it around, and several conversations with the investors, we took the offer of $300,000 and ultimately arrived at a number of $500,000 for the final purchase price of the LP interest. So from the fund's perspective, again, benefits have been delivered. We're in the business to provide affordable housing. The IRR exceeded target. And here the investor was able to capture residual value, and we assigned our interest for $500,000. And our last deal is a nonprofit that does have value. This is a 60% AMI project located in the Southwest. This deal, they did have a buyout option and a right of first refusal to purchase the real estate. If they were to exercise the right of first refusal, there'd be the purchase price. The limited partner would receive $742,000. The general partner didn't have the funds available to exercise any of these options. Obviously, the right of first refusal is the most attractive. So they came to us with a plan to refinance the project and use the proceeds to buy the limited partner interest, or to buy the limited partner interest based on what the limited partner would receive if the right of first refusal were exercised. An important note here is that the general partner did capture, will capture $3.5 million in equity in its real estate. So the right of first refusal is working for that partner, but they need to have the cash assets available to effectuate the transaction. I'm kind of speeding things up here because we're running out of time, but again, this is what the net assets of the partnership look like, comparing the real estate value to the liabilities on the partnership. We come up with net partnership assets of $4.4 million. If we were to exercise the buyout price, the total proceeds will be $3.9 million, and again, this would be a liquidating event, which would trigger the liquidation waterfall. And the limited partner had most of the capital account, all of it here. So all of the proceeds, if they were to exercise the buyout option, would go to the limited partner, and the purchase price would be $3.9 million. If they were to exercise the right of first refusal, the total proceeds to the limited partner will be $742,072. And again, per the liquidation provision in the partnership document, all proceeds would go to the limited partner. So this $742 represented what limited partner would receive if the right of first refusal was exercised. But we didn't we structured it with the same pricing, but took into consideration the needs to refinance the project and allowed for the transfer of limited partner interest versus selling the real estate. Here we just show how the general partner planned on getting the funds to acquire this. They did a LTV analysis of the property after getting an appraisal. They realized that they could get $5.3 million in funding, a new loan. To compare my sources and uses here, we have a new mortgage of $5.3. We had an old mortgage of $4.2, new capital needs of $300,000. You'll notice there's a difference, a delta between these sources and uses, so there's going to be proceeds. The proceeds were a little bit over $1 million. Now this split is negotiated. We basically, general partner said, hey, we can get this much money. This is what you would receive. The $742 is what you would receive when we exercise the right of first refusal. This is what we would like to pay you for the limited partner interest, and that's what we ultimately negotiated. And again, this is just a summary of all the valuation. But we negotiated, we're allowing the general partner to refinance the project, and the fund will receive the same amount they would receive if they were exercised the right of first refusal. And from the fund's perspective, this again allows for long-term preservation of the project. The investor benefits have been realized, and the limited partner is going to assume or capture some residual proceeds of $742,000, and the nonprofit is left with a $3.5 million in equity in the real estate, which is beneficial to them going forward. They have equity that they can use to maintain the project going forward. And some quick takeaways. Capital accounts may skew your distributions, so you want to go through your partnership documents and determine which waterfall is going to be appropriate. The capital proceeds are typically driven or drive any type of refinance distribution and a fair market valuation, but not a liquidation. Agency and lender consent process may delay your process, year 15, so plan early. Capital needs are very significant for these deals, so make sure your planning includes a long-term preservation of the asset. And as Greg mentioned, the HUD study, most of these transfers do involve the transfer of the LP interest to the current general partner. And then so what we see in our portfolio and nationwide is what we're seeing. So we're able to transfer these assets over to, or this interest over to a group that's familiar with the property, and that's our ultimate goal. So we're going to open it up to any questions asked.
Great, thanks, Sean. As you all can tell, we're running a little tight on time. An incredible amount of information there that we went over fairly quickly. So just a couple of notes. One, if you've already added your question to the Q&A panel, never fear. I will make sure that all of our presenters get a copy of all of the questions, and those questions do come along with your email address. So we will be getting back to you, if not during this session, then afterward. And also in the same vein, just a reminder that this session has been recorded, so if you missed any part of it or you simply want to revisit, it will be made available along with a copy of the slides. We generally say about 48 hours. Sometimes it's less than that, but an email will go out to everyone with a link to the archive. And as you can see here on the screen, we have contacts for today's presenters. So if you wish to reach out to them directly, you can certainly do that as well. And I can get in a couple of quick questions, but again, never fear, I will make sure that our presenters get a copy of all of them. Starting back from the beginning, what's your typical expectation in the amount of time it takes to receive soft lender consent to exit?
Well, that's a tough one. That's we're ready, when we have that conversation, we're ready to exit at the end of that phone call, but if there's, in particular, if the value has been negotiated. But if the soft lender, if that's the only consent that's needed, then, and they have that consent lined up, then we're ready to close right away. But typically you find that there's some surprises at year 15, which is why it's really important to plan early, get in touch with your lenders early so they can make considerations.
And I think depending on the state will drive, if you have debt through a state allocating agency, that can drive sometimes the period of time. So, you know, in most cases, we're probably looking at 45 to 60 days. However, if you're out in some markets in California, it can take longer. And if you're located in New York City and you're financed with HPD in New York City, they have an entire year 15 program that requires a lot of underwriting provisions and so forth, which takes a lot of time, sometimes up to a year.
Okay. I think we can get one more in. Are there any examples of public housing authorities that were not successful with maintaining their housing stock after the 15-year expiration or are struggling to do so?
Well, we haven't experienced that here at Enterprise. I can't really speak to that.
Right. Jump down.
I would just add that, you know, particularly with our nonprofit portfolio, you know, we just gave two of the case studies were in that arena. Just in line with the HUD report, the vast majority of the nonprofit partnerships have public debt and with a lot of accrued and deferred interest and really may not have value in excess of debt on the back end. But we thought we would include the third case study, as rare as that is, at least for our portfolio, as rare as that is, it does provide as a good illustration of how that type of scenario would work where you had significant value in a deal with a nonprofit.
Okay. I don't think we're going to be able to squeeze one more question in, but again, don't worry, the presenters will get all of your questions. And Greg or Sean, do you have any, or Candy, do you have any wrap-up words for us?
Just thank you for joining us and plan early.
Agreed.
Okay, great. We are at time. Thank you very much for joining us. Thank you to today's presenters. And we hope to see you online again soon at another Enterprise Live Online event. Goodbye.